Hello and welcome. You're watching Rush Hour and I'm Sumita Kareer. Over the next 30 minutes, we get you the day's top stories from markets, business and politics. And our lead story this hour. While UK inflation has slowed down in June, marking its lowest pace in over a year, coming in at 7.9%. Remember, this was the central bank's target in May this year. Core inflation too cooled off to 6.9%, which is a key metric for the Bank of England to gauge price pressures. Although CPI remains well above the Bank of England's 2% target, it might bring some respite to the interest rate hike cycle in the region. The current bank rate is 5%. In fact, two-year UK government bonds were down too. So what can we expect in the coming months and what are the markets penciling in? To discuss this with me, I'm now joined by Nadia Elbilassy, who's a market analyst at the Equiti Group. Nadia, thanks very much for joining us here this evening on ET Now.
Thanks, Sumita. Happy to be here.
Right. So, Nadia, UK inflation springing in a rather pleasant surprise, but still above the central bank's target. Now, is this looking like the glass half full, and what has really contributed to this surprise drop?
So, yes, we're starting to see major economies seeing inflation drop down. We're seeing that UK inflation has finally moved away from the 8% area and finally went to the 7.9%, which is good news for the UK because the economy was in fact really slowing down. Inflation was really high in the past period. So I think this is really good news for the economy. Also saw the FTSE 100 surge more than 2% already today. So we are seeing some positive market reaction to the news. Despite that, we are still well above the Fed's target, like you said. But I think that now we're pricing in more rate hikes from the Bank of England to curb inflation because after all, the target is still 2% and we have a long way to go. So yeah, the outlook still remains dim for the UK as we see that the effect on the economy is actually slowing down, and what's contributing to that is the economic indicators that we're seeing, like retail sales or industrial production, and so forth. All these economic indicators do reflect a slowing down economy, and we've already seen that also the Eurozone has been in a recession with 2 quarters of contraction, and we're seeing a lot of let's say the economic indicators also reflecting a slowdown in the economy and a recession. So it's not so much a soft landing for the UK or the Eurozone, while in the US we can say otherwise. However, now that's what markets are focused on.
Right. So I want to also talk about the rate hiking cycle, which might slow down looking at, these numbers. But let me also first ask you, while I did mention in my opening presentation that there might be some softening, right, as far as the rate hike decision goes. And yet, in the context of the markets, it has made all the difference. Although the difference between the inflation print that has come out now and what was expected, there's not much difference. But that difference could be a real game changer for markets, because earlier this month, the markets were forecasting that the Bank of England would put the UK's key interest rate up to 6.5%. But now markets are thinking that the Bank of England rate hike will peak at less than 6%, and that seems like a big shift. What do you think?
Yes, of course. From going down from 6%, it would be so much better for the economy to grow, to see substantial growth in the economy after the slowdown period that we're seeing right now. We're seeing a lot of stocks recover. We're going through a partial recovery period actually for markets right now, as we see inflation actually cooling down, economic indicators like retail sales also cooling off. We're seeing because it's summer season, so obviously a lot of that money is going to travels and so on and less on sales, and that's why we're seeing a little bit of a shift in the economy right now. We're also seeing as inflation cools down, which was the biggest fight in 2023, and that's why the stock market was doing bad at the start, but now we're seeing a kind of recovery period. So I think this is why this happens to be a big shift, and for the Bank of England to take a step lower from the 6%, it's definitely going to boost the economy a little bit at least, so that we don't see a very dim outlook for the UK.
So not all a dimmed outlook, but whether this is indeed a watershed moment for the US market, that remains to be seen. Let me also ask you before we let you go. PM Rishi Sunak has also set a target of reducing inflation to 5% by the year end of 2023. But looking at the monetary policy, do you think that's a challenging target or something that can be met?
I think that can be met. I mean, we've already seen, if we look at the US economy, where we are right now at levels of 4%, I think that hiking interest rates has a really good effect and strong effect on slowing down inflation. It's actually one of the only tools available for central banks to use, and that's why they go back and they hike rates every now and then. And this is the tool that they've went through, basically.
Right. So all eyes now on that very, very crucial meeting on August 3rd and when the Bank of England sits and decides what happens next on August 3rd, well, whether it'll stick to the 5% or will there be a slight spike in interest rates. On that note, thank you very much once again, Nadia, for joining us this evening. It was indeed lovely having you on ET Now.
Thank you, Sumita. Always a pleasure.